Victoria, so good to see you. A really important question today. When should you start taking money out of your 401k? A 401k is one of the most powerful retirement savings tools
Mhm.
available, but if you take the money out too early, you could face penalties, wait too long, and those RMDs could push you into a higher tax bracket.
Right.
And let's start with the basics because I feel like for the most part, we save in those tax deferred 401ks. Why is that important?
Mhm. Well, first of all, fewer and fewer individuals are going to be receiving a pension.
Yep.
So the retirement accounts are really essential to help us plan for our retirement.
Mhm.
And many employers offer a match. So if we're not contributing to those accounts, we're basically giving up free money. The second thing to consider is that those tax deferred accounts can be advantageous with people who are in the 32, 35, 37% tax bracket because they get to take a deduction in the year that they're making that contribution. Although I'm going to just take a pause there. If you're in that 22, 24%, or you have a long horizon, you may want to look at Roth 401ks because there, the Roth 401k, as your money grows, you don't pay any tax. And when you take money out, you don't pay any tax. And who knows what those tax rates are going to be in the future.
Yeah, that's a really good point. So, before we circle back to that, I do want to talk about what happens if you tap your 401k too early. Can you explain what you're giving up, please?
Yeah, it's quite a bit. So, first of all, your dollars are taxed at whatever your ordinary income tax rate is. And if you are under the age of 59 and a half, you actually have to pay a 10% penalty on
Mm,
those dollars as well. So now you're giving up potentially 40% of your assets just in the form of taxation and penalty. Now compound that over 10, 20, 30 years. That's a significant difference that can make a big difference in your retirement plan.
right. Now, when you are allowed to tap the money, generally at 59 and a half, can you explain how those distributions will be taxed, please?
Yeah. Well, the IRS has a fancy name for that. It's ordinary income rates.
Mhm.
And I often ask, like, what is that rate? And I get blank stares at me, right? So we know what they are today. So currently our tax rates are 10, 12, 22, 24%. So you end up having to stack all your other income streams in. So whether that's a pension or Social Security or rental income, and then your tax deferred distributions from those IRAs, 401ks are taxed at whatever your highest marginal tax bracket is.
Mhm. All right. Now, at some point, the government says you've waited long enough. It's time to start taking that money out. Again, we're
Yeah.
talking about the tax deferred accounts. Can you explain RMDs and when they start?
Yeah. So required minimum distributions up until about 2019, it was 70 and a half. Then they made some changes. They keep pushing that out. You can see if you're born between 1949 and 1950, your RMD age was 72. Fast forward to today, anyone born from 1960 forward, your required minimum distribution date is age 75. Whether you need that money or not, you are having to take a percentage of those accounts out each year.
Mhm. It's easy to see, Victoria, talking this through with you, why these tax deferred 401ks are known as ticking tax time bombs. So, what strategies could I put in place today to help mitigate that tax bomb that's kind of coming, that I see coming down the road? And how can I just figure out how much I should be withdrawing from my 401k?
Yeah, well, ultimately, the goal of financial planning and retirement planning is to optimize your assets. So
Right.
when we sit with folks, we literally look and see where are their assets today?
Hmm.
What percentage is in taxable accounts that are generating 1099s? What percentage in tax-free accounts?
Yeah.
Those accounts that grow tax-free and distributions are tax-free. And what percentage is in that tax-deferred account? We map that out. We look at what your expenses are, what your long-term goals are, including legacy goals, your concerns about long-term care, and we build out a plan. And that plan really helps us identify whether or not it makes sense to do Roth conversions. Roth conversions for some makes the most sense. It also helps us identify how much to take out each year to prevent that tax torpedo coming.
I'm so glad we had time to talk this through, Victoria. Clearly, proactive planning is key. So, if
It
somebody would
is.
like to sit down with you and kind of crunch the numbers, talk through some of these strategies like Roth conversions, what's the best way to reach you?
They can contact us at info@vitalityinvestments.org.
Great. Again, Victoria, thank you for your time today.
Thank you.